I worry about the bond market. I worry about long-term interest rates. There's just so many things going on in that market that make me nervous. It's very fragile. As you know better than I, lots of volatility in rates for lots of different reasons. The owners of treasuries have shifted from price-insensitive investors like the Fed to price-sensitive investors like hedge funds. That just makes me nervous.
Welcome to Private Capital Call, the podcast with leaders in asset management, investing, and capital markets. I'm your host, Randy Schwimmer. This month, we're pleased to welcome Mark Zandi, Chief Economist at Moody's Analytics, a leading provider of economic research and analytical tools. Dr. Zandi oversees Moody's economic research and is a trusted advisor to policymakers, businesses, and the media. He's also the author of Paying the Price and Financial Shock, described by the New York Times as the clearest guide to the financial crisis. He also co-hosts the Inside Economics podcast. Mark Zandi, welcome to Private Capital Call.
Thanks, Randy. It's really good to be with you. Appreciate the opportunity.
Well, it's great to have you. And I think we probably have had you on the Lead Left series historically, but it's been a while. And we thought that particularly after seeing you live and on stage at Moody's Private Credit Conference in New York a few weeks ago, doing a masterful, without slides presentation, by the way. You offered to have the slides, but you said, we have a few minutes, let's just do it without.
Do I have a great backstory for you on that one? But that's for another day.
Well, you did. You did a great job. It was seamless. It was like a mini TED Talk. So hopefully you can reprise some of your insights from that. But, I think even in those succeeding few weeks, once again, the economic and political landscape, I guess, has shifted. And here we are on July 9th, as we tape this, looking at fresh tariffs, new and improved, coming out of this administration. And I guess before we get into that, maybe you could just, from your perspective, remind us of where we are with the economy, because it feels like with all of the distractions going on that interest rates probably will start to come down at some point. You can talk about that later. Growth is slowing, but seems to be generally still hanging in there. Inflation, not too awful yet. I mean, we'll see with this latest round. And job growth, we're still seeing new jobs coming out, and the unemployment rate still kind of in the low fours. So seemingly everything is okay. But if you could give us the expert opinion, maybe starting with, current consumer spending and take it from there.
Yeah, sure. I think you said it correctly. The economy's okay. It came into the year doing well. Just to give you a number, last year, real GDP, that's the value of all the things that we produce, grew just under 3%. That's a good year. It feels like in the first half of 2025, and we haven't gotten all the data in, but it feels like growth is going to come in about half that, about 1.5% annualized for the first half of the year. A little weaker in the first quarter, a little stronger in the second quarter, about 1.5%. And that kind of encapsulates for me how the economy is performing and how it feels. And you can see it, this downshift in growth, most significantly in consumer spending. So American consumers kind of drive the train, the economic train. They're just not driving it quite as hard. In fact, if you look at overall consumer spending, the whole shoot and match, from goods to services, and you look at it after inflation, it's gone flat since the end of last year. So we have the data points all the way through May. You look at May spending, it's a bit lower than it was in December of 2024. So, that is somewhat disconcerting because that also includes all the forward buying that people did in anticipation of the price increases related to the tariffs. So that's a cautionary note. And you mentioned jobs. You're right. The economy continues to create jobs, but that's also downshifting now as well. And I think if you abstract from the vagaries of the monthly data, job growth is about 100K. Just to get another statistic, the average monthly job growth last year was like 165, 170. So, it's okay, but it's downshifting. And of course, none of that accounts for, what's dead ahead. And that's the price increases related to the tariffs. They're coming. And we'll have to see how the economy digests that.
And post-Liberation Day, because we are in a pause, it felt like some of those effects were going to be delayed. And while there were certainly goods that have arrived on docks, and in ports over the last 30, 60 days, doesn't feel like, at least in the numbers, any significant price increases. But with the news this week that I sense could change.
Yeah, they're coming. I think the price increases related to the tariffs have been attenuated for a number of reasons. One, tremendous front loading of imports. Importers saw the tariffs coming and they brought a lot of product into the country back in January, February, March, coming into April. That's not unexpected, but what we got was a tsunami of import, much greater than anyone anticipated. And importers are still working through that inventory. And so that's delayed the price increases. The other factor is that tariff increases, the actual tariff increases have been much smaller than you might think, certainly given all the rhetoric. I mean, the effective tariff rate, that's the actual tariff rate that is being paid across all products, is about 8%. That's up from 2.5% since the beginning of the year. So that's not inconsequential. It's meaningful, but it's not 20%, it's not 25%, it's not 50%, it's not 150%, all the numbers that are being bandied about. So I do expect tariff rates to continue to climb, probably see them settle in around 15%, I think, by early next year. But so far, they've been relatively modest. And then the other factor is that businesses, we know Americans are paying the tariffs because you can see it in tariff revenue. We have data from the Treasury Department, we can see time. So it's not like foreigners are paying it, it's Americans, but it's mostly so far businesses in the form of lower profit margins. They're eating it, as they say. Now, they'll do that for a while because they're unsure of where the tariffs are going to land and they don't want to raise prices and lose market share and then get whipsawed and those tariffs go right back in. So they're taking a bit of time. And the other thing is if you're a big retailer or a large US company, you really don't want to get into the political spotlight here. So you're being very cautious in raising prices, at least for a while, to see how things settle. So there's a lot of reasons to think that the price increases, while they've been delayed or attenuated, they're coming. We're going to see higher prices here in the not too distant future.
So connected with this, Mark, is, and you've talked about this before, is the risk of recession, because there was a number which a few years ago nobody even paid attention to because the risk of recession was so minute because we had a much stronger economy. As you mentioned, a 3% GDP, you're not usually in the position of worrying about a recession, but that became pretty real again after the first quarter. Goldman, I think, just came out with 45% chance.
Did they raise it?
I think so. I mean, I'll double check the numbers, but it seemed like at least a month ago that was similar to what you were talking about, but would love to kind of get your current thinking, just given the slowing of the economy.
Yeah. So economists have gotten into the position of having to state their views on recession by what's the probability the economy is going to start or enter into a recession at some point in the next 12 months. And I'd say at this point, 45% feels like a pretty good number to me. It's less than even. I think we'll be able to navigate through without a recession, in significant part because I think the administration is showing a willingness and ability to pivot. Anytime things feel like they're going off the rails in the stock or bond market or economy looks like it's weakening, they'll pull back on some of the policies and allow the economy to kind of navigate through. So I think they'll continue to do that. So less than even odds, but still very uncomfortably high. And, that's because if the economy is weakening and throttling back, and I think it has and will continue to do so, that means the economy is vulnerable to anything else that can go wrong. And goodness knows, there's a lot of things we can imagine that could go wrong, and there's a lot of things that we can't imagine. One interesting, at least to me, interesting thing is we have built a model based on a random forest algorithm. It's kind of a machine learning algorithm that is based on all the data that we have in our databases. And, we got tons of economic, demographic, financial data, US, all over the world. And we use this to go through all the data, all different kinds of transformations, and constructed a leading indicator of recession. What's the probability of recession in the next 12 months? And, Randy, what it's saying for the month of June, saying 48% probability of recession.
Oh, okay.
So there you go. Very consistent with kind of my prior. I think that says it nicely. I think we'll be able to avoid recession, but it's going to be pretty darn close and the risks are high.
Yeah. And I think that I just confirmed the Goldman view at 45%. So that seems reasonable. It still seems high to me, but on the other hand, like you said, less than 50%. If you're at 10% right now, that's probably looking a little optimistic. If you're at 80%, a little doom and gloom. So this is probably.
So what would you put the probability at, Randy? What's your census?
Well, one of the things that I've learned, and because I've been publishing like you a lot, and I do it every week since March of 2008, I've discovered that one of the beauties of publishing regularly is that you can adjust quickly, right? Based on what you've been saying,
That's a
right?
good point.
And you can
Yeah.
adjust it quickly. But I have found that when people say recession,
Uh-huh.
what do they mean a technical recession, meaning two consecutive
Uh,
down quarters,
right.
which, by the way, we had not that long ago. Nobody even noticed it. They were more technical and oriented. They were,
Although
I
that got
think,
revised away. It ended up
yes,
only being 1 quarter, I think.
I
Yeah.
think that's right. So,
Yeah.
but one could, and even prior to that, I think we had a technical recession. But the
Uh,
point is that different than a real recession, right? Because now
yeah.
when people think about recessions, they're
Right.
thinking, like GFC kind of event. And so I don't think we're going to be headed into that. Or I guess
Mhm.
my question to you is the consumers always kind of rescued us. Do you think
Yeah.
that what are the variables that could change for the benefit of the economy? What kind of cushions are in place?
Well, I mean, it's about jobs, right? I mean, let me answer it first this way. I mean, I think the consumer is very vulnerable because consumer spending all in, as I said, is flat. And that's before the price increases related to the tariffs kick in. And that's before we see the backside of all the forward buying. So I think the risks are decidedly towards consumer becoming even more cautious with regard to their spending. And that's why recession risks are as high as they are. But the key ultimately is jobs. If businesses kind of look through the weakness in consumer spending and don't start laying off workers, and right now they remain steadfast in avoiding that. They pull back on hiring and they've cut hours. So they are, they've turned more cautious with their workforce. That's why job growth has slowed. Quit rates are down, but they have not increased layoffs. And, to get a recession, an actual National Bureau of Economic Research defined recession, which is a broad based, persistent decline in economic activity. That's how it's defined. And it's mostly around jobs. I mean, at the end of the day, if you start seeing job loss, that's consistent job loss, for 4, 5, 6, 7, 8 months. That's a recession as defined by the NBER. If businesses hang tough, look through the weakness that is coming, don't lay off workers under the view that this is all going to be temporary and they don't want to lose workers and the labor market's already very tight and they don't want to be in the position of having to go find workers when there aren't any, then I think we should be able to navigate through. That's the cushion that I think that's available. The other thing is wealth. I mean, a lot of the spending is done, the bulk of the spending is done by folks in the top part of the distribution. By some of the work we've done, the top 10% accounts for 50% of the spending. And they're very focused on their net worth on the stock market and the equity they have in their homes. And, right now there's a lot of wealth. And as long as that remains the case, they'll do what they typically do. And if they do, the economy should be okay too. So that's another cushion. And then, as you pointed out, we should see at some point here as the economy slows, the Fed start cutting rates again. I
Yeah.
don't expect long-term rates to come down to any meaningful degree, and we could talk about why, but short rates will come in, and that helps. That helps with credit card interest payments, and helps out with certain kinds of personal loans, home equity lines, that kind of thing. And so that it helps small business people because they're tied to prime, which is tied to the funds rate. So that should take some of the pressure off as well. So another cushion, as you say, that could help kind of us navigate through. And finally, I'll just say we did get a BBB, the big beautiful bill that got through Congress, the reconciliation package, a pretty big package. In the grand scheme of things, I don't think it means much for the economy, but in the very near term, in 2026, you'll get some tax cutting, particularly to businesses and some of the other personal individual tax cuts. And so that should help support the economy a little bit, not lots, but a few tens of basis points on GDP, will be helpful. So there are a few things out there that should help us kind of navigate through without,
Hmm.
descending into a black hole.
And where do you think, how many rate cuts this year do you think from the Fed?
Well, I opine about many things. Some I'm confident, some not so much. This would be the not so much. I mean, I do expect that by September, the Fed will have concluded that the price increases related to tariffs will be temporary, that they're not going to be persistent, and that we'll see definitive signs of slowing job growth will be well below 100K per month. Unemployment might be ticking higher, although that's affected by all the labor supply issues with regard to immigration. But we'll see some stress in the labor market, and that'll be enough to get the Fed moving again. So I expect to cut quarter point in September, one in December, and then one each quarter in 2026. And the funds rate will settle in by the end of 26 around 3%, which is kind
Okay.
of the equilibrium, neutral rate.
Okay.
Yeah.
So, and that sounds like a positive, right, for the
Yeah,
economy,
positive
right?
for sure. Yep.
And it certainly the last CPI that I saw was pretty tame. Now I know that we'll see what happens June, July,
Yeah.
but that would be good. I think just moving into private credit, which is obviously what
Yeah.
we talk about here, talk a little bit about the macro, and then we can talk about private credit and how we're seeing it sort of the middle market level.
I think it's been a pretty difficult environment, because rates are high. The Fed ended its rate cutting with a funds rate that's elevated, a little over 4%. 10-year treasury yields have pushed up. We're kind of sitting around 4.5%. There's a lot of uncertainty around economic policy. What about the tariffs? What about the Doge cuts? What about immigration policy? What about the reconciliation bill and all the tax provisions in there? So there's a lot of kind of moving economic policy balls in the air. And the one thing going for the market is the economy continue to move forward, right? I mean, businesses are still selling and, raising prices, and margins are wide and profitability is good. So, but the net of all that is, kind of a market that, I'll use the word I use to describe the economy. It's okay. It's okay.
Yeah.
Now, if rates come in as I anticipate, particularly the short end, and the economy the uncertainty around economic policy abates, and I would anticipate it's already abating. We've got that piece of legislation across the finish line, so that done. Let's move on. We get some clarity and get to the end game around tariffs and immigration policy, then that should abate. And as long as the economy kind of hangs tough, it might feel a little uncomfortable over the next 6-12 months, but as long as it, hangs tough and businesses can maintain margins, then the market should start to feel better, over time.
Mm-hmm.
It's not going to be, there's no crystallizing event here. It's not like I'm going to go from feeling okay to feeling great. That's not what I think is going to happen here. I think it's going to feel okay. I feel okay. Oh, I feel a little bit better. I feel pretty good. A year from now, I feel good. Something along those lines. That's kind of sort of how I think about it.
It feels like when Liberation Day came and went, now again, we'll see what happens with the current version of that the work that these sponsors were doing with these companies, like a pest control company, is like, you know what? Regardless of sort of what's going on, we are not going to, and I'm a perfect example, like I'm not canceling my termite contract. I'm sorry. That's just, and my pests, my ants, all that kind of stuff. I'm not canceling that.
Yeah.
There's certain things like HVAC repair, landscaping, things that's like, I need all this. And so I think for certain parts of the economy, these equity sponsors are feeling good. And particularly now as we see the purchase price multiples, Mark, that are being held at pretty lofty levels. And I'm talking about low double-digit multiples for businesses that have thrived over the last 5 years. I'm not talking about in general, but for some focused buyers and frankly, some smaller sellers. These are founders of small companies who are eager to kind of be competitive and realize they can't be that competitive without capital and real partnerships from larger private equity firms. So I think it may be a little bit ahead of where the macro or the larger businesses are. We'll see what happens. One of the things you've also talked eloquently about is private credit and sort of systemic risk, because I think that there's always concerns out there, particularly in an asset class which is less visible than public credit. And talk a little bit about, from Moody's perspective and economically and just analytics viewpoint, as to how private credit fits in the economy and your view about the financial system and how over the next few years that asset class will fit in.
Yeah, sure. And I did write a paper with a few colleagues and a couple of other folks. So one from the SEC and a former Treasury official who's now has his own private equity firm. We wrote a paper. You can find it, Private Credit and Systemic Risk. You can Google it, Zandi, Private Credit and Systemic Risk. It's a bit dense, so you might want to use Notebook LM, to digest it.
Explain
Get the podcast going on the book LM. We use a number of different statistical techniques to try to understand how the systemicness of the system has shifted as private credit has come on. And we use BDCs as our proxy. There's issues with that. Obviously, BDCs are an imperfect representation of what's going on in the private credit markets. And I think that'll be increasingly so as we go forward. But we dealt the hand we were given. That's where the data is. And bottom line, what we found is that, not surprisingly, private credit has become more central to the system. You go back to the financial crisis, the system was more of hub and spoke with banks in the middle of the web. They were the hub. And then life insurers, non-bank financial institutions, BDCs kind of revolved around the banks. That changed dramatically because of the GFC and the policy regulatory response. And now if you look at the web, it's not hub and spoke, it's actually a web. The BDCs are, interspersed throughout the system. And, you can interpret that in different ways. I mean, what the positive is that, because the system is more diffuse. I mean, there are more connections. There's a lot of so-called denser connections, but it's more diffuse. It's probably in a better spot to digest shocks that are kind of garden variety shock, kind of typical garden variety things that don't kind of stick to the script, go off the rails a little bit.
Yeah.
Because the shock propagates throughout the system and the risk is distributed more broadly and the losses are distributed more broadly. But it does raise the concern that if you see a very large shock, something like GFC then that might become more of an issue because the entire system is now at risk of going down. There's no one place the Federal Reserve could go to kind of provide a backstop, and provide that backstop is then provided to the broader system. So that's a concern. And adding to the nervousness around that, it goes to the fact that we don't have complete transparency with what regards going on, or certainly less so than we have in the banking system by definition. BDCs, yeah, they're transparent, but outside of that, not so much. And I think just for context, there's, say roughly 2 trillion in private credit out there, including dry powder in the US, and BDCs are what, 250, 300 billion, something like that. So there's a lot going on there. And the other thing that makes me nervous, and this is kind of a tangential point to the point about transparency, is price discovery. You get mark to model as opposed to mark to market. And, even the banks don't completely mark to market, but you have a much better sense of the marks. You don't really have that in lots of private credit. So it makes me a little bit more nervous. Not that it means something's off the rails. It just means I can't judge what's on the rails or off. It just makes it more difficult and thus adds to my risk, but my nervousness. But broadly speaking, the system has evolved in a very clear way from hub and spoke to something that's more networked.
Yeah, which I think is where this is going to continue to go. I just think the markets are going to be more dispersed, less concentration, and certainly look at our own portfolio where there's just so much lack of concentration that any one little issue is not going to affect anything much. And that's kind of been our success over the last 20 plus years. And I think others, experienced lenders who've been through this before, see that and they realize that if we're wrong, we just don't want to make sure it affects anything that we're doing. So I think that's a great point. Just to kind of wrap up, Mark, I'd love to get, and I usually ask this question of our guests at the end. Number one, kind of biggest surprise so far this year, something unexpected. Can be personal if you want, but just anything that occurs to you. And then when we have another discussion, maybe a year from now, and look back, what will be the biggest surprise that will be in store for?
Well, I have to tell you, economic policy has been a surprise. Not we have seen Doge cutting or tariffs or restrictive immigration policy or tax spending bill that got through the legislative process. Those things, President Trump was very clear he was going to pursue. And whether you like him or don't like him, the one thing you can certainly say is he does what he says he's going to do. That was what happened in his first term. Clearly is what's happening in his second term. The thing that surprised me was the scale of the policy changes and the pace at which the changes have come. That has surprised me. I did not anticipate that. So I knew tariffs were coming. I just didn't know we had tariffs going from the effective tariff rate going from 2.5% to I think 7.5%, not 15%. Not 40% on China. And then on immigration policy, same deal. Reconciliation bill, same deal. It's just much bigger than I would have thought, and all the moving parts. So that's what surprised me. The one thing that I'll just call out, and this goes to your question about we have a conversation a year from now, the thing that might be a surprise. And you can tell I'm still very cautious on things. I'm kind of got my baseline view that's we're going to make our way through that recession, but I think recession risks and risks more broadly are to the downside. I worry about the bond market. I worry about long-term interest rates. There's just so many things going on in that market that make me nervous. It's very fragile. As you know better than I, lots of volatility in rates for lots of different reasons. The owners of treasuries have shifted from price-insensitive investors like the Fed to price-sensitive investors like hedge funds. That just makes me nervous. You've got a lot of debt coming. The reconciliation bill, I don't think it makes the deficit any worse, but it doesn't make it any better. And it's bad. 6% of GDP and interest payments are soaring. Debt loads are rising. And I do worry about foreign investors and how they're looking at the U.S. as a safe haven context of all the things that are going on. So I can go on, but this is a concern that's being expressed now more broadly by others that follow the bond market carefully. So it's not something new, but I think, at least at this point, but I do think that's the thing I worry about the most, the thing that could go off the rails and do a lot of damage. Because if long-term rates rise, if the 10-year goes from 4.5 to 5 or 5 to 5.5, all asset values are going to be down. The economy's going into recession. We've got a world of hurt, dead ahead.
Mark Zandi, Chief Economist at Moody's Analytics. Mark, thank you for joining us. We will post whatever you send us in terms of papers and graphs and charts so that all of our listeners can have access to that. But I encourage everybody to go onto the Moody Analytics website and sign up for the Inside Economics podcast with Mark Zandi. Mark, thanks so much for joining us on Private Capital Call.
Anytime, Randy. You got to be a little nerdy to enjoy my podcast, though. You got to be a little nerdy with the data. So I sense you guys are. Yeah, you're nerdy.
We're nerding out every time we open up the screen, and we're looking forward to creating the same safe environment for our nerdy friends out there. So appreciate it.
Thanks so much for the opportunity. Take care now, everyone.
Thank you.